So my topic today is the industrialization of cryptocurrency mining, and I'm going to talk about how it happened to Bitcoin, why it happened to Bitcoin, and what are the implications for this development, and it's now happening to Decred, and what kind of benefit it brings to Decred, and what kind of opportunities are there for smart investors. So miners are now perceived as the new barbarians at the gate, which is a phrase termed for in the 80s for companies like KKR that do large LBO buyouts, very aggressive companies. And the reason mining as an industry has developed so quickly. Can you hear me now? How much did you miss? Well, I didn't say anything interesting anyways. So anyways, at this point, despite cryptocurrency is still in its nascent stage, but mining it has developed into a monstrous industry. In 2017 alone, the mining rewards has amount to $3 billion. And according to a rough estimate, the big mining players, the mining companies such as Bitmain, Canaan, Bitfury, has reaped close to $7 billion of revenue. And we know most of them come from Bitmain alone. So this has obviously become a very large industry, and with Bitmain poised to become the first company that go IPO, well, a real IPO with $16 billion of valuation. So how did this happen? The obvious answer is there's a lot of money in this. But with the process of industrialization, it took many steps and many processes. And the key drivers of mining industrialization, I think there are 4 core elements. The first is the rapid iteration of mining hardwares. So starting with CPU mining, with GPU mining, the time that you can just plug your laptop to and start mining in your garage is definitely gone, at least for Bitcoin. And at this point, very advanced bleeding-edge machines that uses 7-nanometer tech nodes are coming out every day. So ASIC machines are coming out very quickly, and their prices are dropping very quickly as well. And the second thing is power consumption. And if you are running machines in your garage or your mom's basement, that period is over as well. And if you're running your machines with like 10 cents per kilowatt hour, you're out of business very soon. So, and we all know that cryptocurrency mining is a electricity-eating monster, which means require you to optimize on your cost of electricity very, very cautiously. And lastly, your mining facility is incredibly important as well, especially if you're running these machines at scale. And so the phrase that the data center is the miner actually originate from a phrase that a Google engineer who designed the data center for Open Compute project, he called the data center is the computer. And this is because the architecture for designing a data center naturally extended from the architecture for designing a computer. So mining facility has to be very, very efficient from your electric design, your mechanical design. They have to fit the needs of these high-density Bitcoin machines very, very well. And lastly, the mining pools, which is a topic that media or the rest of the world doesn't understand very well. These are the hidden titans on the network. These are the real points of concentration. These are the people operators that really control the growth of the chain. So we're going to talk about all these 4 components in sequence with a strong focus on ASIC machines. So running mining operation at scale has a lot of challenges, and you require you to think about a lot of operational considerations that's beyond just protocol layer stuff. One most important thing is to source the right hardware from the manufacturers at a fair price, because the unpredictability of the cryptocurrency price and also hash rate growth in the next few months, by buying a hardware at the price that you pay, you're basically buying a forward option. So who you're buying from, at what discount you're buying from, whether you have the right connection, and whether your machines are actually working when you buy them, and how much delay you get from after purchasing these machines. These are critical. And what's the hardware cycle? if you buy a Bitcoin miner and 3 months later a much better machine comes out and your hardware is basically obsolete. And the cost of energy, the overheads for running the facility, these are all the points that we touched earlier, and security and staffing of the host machines. If you run a high-profile cryptocurrency mining operation, there will be people who try to come to your facility to sabotage, especially if you're running these operations at places that outside United States, somewhere remote. You might need to equip your data center with machine guns. And after you produce these rewards, how are you going to manage them? Are you just going to hot them, or are you going to actively trade them? So these are also consideration for an active and smart mining operator to consider as well. And lastly, local regulation and tax, obviously. So for Bitcoin, in the past few years, the hash rate has grown significantly. From the chart on the left is a chart produced by Professor Michael Taylor from Washington University. So from the chart on the left, you can see every time there's a new techno being used in cryptocurrency mining machines, that you get a tiny little leg up on the difficulty. So obviously, this trend is going to get flatter after we go into a relatively unexplored realm of Moore's law, when we go into a 7 nanometer, when we go to 5 nanometer, when these electrons behave very mysteriously, this effect will be much interesting as well. And on the chart right, you can see the unit profitability per gigahash per second. And you can see that it's dropping very significantly as well. At this point, I don't even know what you can make with just 1 gigahash per second. So with that trend of difficulty going up, it is particularly interesting this year because we all know we're in a very miserable situation in the market right now. So beginning of this year, hash rate, which is the line that's trending up, Bitcoin hash rate has been just going one direction and non-stopping, with the only exception is in, I think, June or March, there was a huge flood in Sichuan, China, where most of the miners are hosted and some of the mining facilities were flooded. So mining difficulty dropped 3% temporarily because the machines are flooded. And this also just shows how concentrated the mining scene actually is. You have a flood and difficult. That's the only reason that difficulty drops 3%, despite the price, which is the miserable-looking chart trending down. It's going one way down. So there's clearly a disparity between the traders and the miners. And so why are the miners still doing this? Why are miners still plugging in these machines? Are they just stupid, or they don't see what's going on with that we're in a bear market? And in fact, this combination, a rising difficulty plus a miserable price, this is actually the worst combination for a miner, especially if you're not operating at basically free electricity. So the reality of that is there is a disconnect of timing between the hardware cycle and the capital market cycle. And the foundry lead time, which is about usually 3 months ahead of the pricing cycle. So it takes a long time for the change on capital markets to get baked into or reflect to the supply chain of the hardware. So in late 2017, when we experienced this massive bull ride, many new manufacturers started participating in this market, and especially Bitmain. In their IPO documents, it's actually pretty interesting that they openly admitted that misjudged the temperature of the market in 2018, so they placed too much order for allocation at TSMC, which is the foundry that manufactures the wafers. So these manufacturers are they continue to sell machines at discounted price despite the cryptocurrency prices going down because they have no choice. They have to recoup the price through sales. So even though price is dropping, we still see miners buying equipment or manufacturer themselves mining with the inventory that they placed in late 2017. So recently, we actually start to see Bitcoin difficulty growth slowing down. And if this bear market continues, we'll probably see, finally start to see Bitcoin difficulty start to drop. So just to show you how crazy the overcapacity is, so the chart on the left is a equity research report put out by Morgan Stanley on TSMC. So TSMC covers majority of the wafer allocation for cryptocurrency hardware. So the estimated in first quarter of 2019, majority of that wafer is actually 7 nanometer. And as we know, the 7 nanometer, even though the technology for 7 nanometer is still very much immature, but they represent just how much determination for the manufacturers to even spend this kind of expensive cost upfront to get the best product out there. And the big reason is that Bitmain is no longer the monopoly that controls the market. There are many new upcoming competing manufacturers with better products that are coming online as well. So the chart on the right is also Morgan Stanley's estimate of how the mining capacity cycle looks like, although the exact reason that they state in on the charts are not necessarily right. So they seem to think that 7 nanometers are these magical little thing that you just plug in and they start cranking out hash rate. But they did their best. I think the general shape of the curve is in alignment with how I think about what's going to happen and should this bear market continues. Very soon we're going to see these newer iterations of machines that runs on 7 nanometer or 10 nanometer come flood the market. And once that happens, if price doesn't change or it continues to go down, a lot of miners that are running at even average operation cost today will have to start unplug. So that's going to have a very interesting effect. So the big overarching question is, there are obviously a lot of actions going on in the miner world, but all these explosion of hash rate, this overcapacity, what kind of implication does it have on the overall cryptocurrency health? If you pay close attention to the narrative of especially Bitcoin world in the past few months actually, or year, the big monster that they're dealing with is the concentration of how much power that miners have, whether it's pool operators or just manufacturers or large miner that hidden in the mountain. So we see a lot of the conflicts within the Bitcoin community is because of that power imbalance. And now even with Bitcoin Cash, that Jihan and Craig Wright are having the problems because they both control a certain amount of hash rate. So this is ridiculous, right? So why does hash rate, why are miners causing so much panic? Why is this happening? This is because in a cryptocurrency system, there are fundamentally two different types of consensus. One, the first and most intuitive is the consensus about history. And this is referring to how miners decide to grow the chain. In your traditional Nakamoto consensus, the miners just build on the chain with the largest difficulty. So in cryptocurrency system, because there is no centralized manager of the ledger, the understanding of which reality is real is pretty much probabilistic. Well, the same can be said about this physical universe, but that's a different conversation. But so obviously with too much control on the consensus of the history, what it can lead to is what I call delicate balance of balance of terror. This is originally a term in the 50s where the nuclear strategists devised on the relationship between the major superpowers that have nuclear power. So they all point their warheads against each other, but nobody's really dare to do anything because the end result is just the collapse of, in this case, the cryptocurrency, the value of the entire cryptocurrency network. So in a network that's controlled by a large mining cartel, that's very much a similar case, that these people control the nuclear options on the the survival of the network. And a different type of consensus, which is less commonly said, is the consensus about the rules. And this is actually a very common thing in all the open source software, where in the 80s, this computer scientist, Eric Raymond, wrote this epic article called the Cathedral versus Open Bazaar, where he talks about different approaches to developing open source softwares. And the Cathedral approach is basically a top-down, where there is a specified hierarchy of the sequence of development and how this project should look like over time. And the open bazaar approach is bottom up, where it's much less hierarchical. But overall, in cryptocurrency systems, the consensus about rules is what kind of rules that this protocol should implement. And in Bitcoin, this is very much controlled by Bitcoin Core and the mailing list that they communicate, have most of the discussion. And what this can easily lead to is the tyranny of the structurelessness. So in a system where there is no formal structure, it's very difficult for newcomers to understand what are the hidden rules. And the process for making contribution in a informal structure, the problem is that they usually have a circle of friends, or people already trust each other. It's very much like a fraternity. So even though it has the reason I chose this picture is because even though you think you guys are the same and as a newcomer, but it's very much not the case. There are a real hidden power structure that's invisible to newcomers. So what the effect that this produces is that core developers can have a very strong claim on the direction of the network going. A typical example would be Ethereum Foundation, and when they make a decision, it's very much just a couple people, and despite the appearance of being open, and quite a few projects can actually fall under this category that has this tyranny of structurelessness. I won't name them because I don't think I'll be able to step out alive today if I just name every single one of them. So in the first iteration of cryptocurrency, where the miners pretty much controls the entire distribution of the Coinbase rewards, in order for the core developers to push back on the mining cartel, they have to very quickly aggregate among themselves, and thus forming the tyranny of structurelessness. So what happens is you can see this kind of extremes very frequently in these networks. So this kind of fundamental imbalance of power led people to start thinking about, okay, maybe the problem with this governance structure is within the consensus mechanism themselves. So people start to explore alternatives. There are already too many proposals out there. I'll just focus on the most popular one, which is proof of stake. I assume most of you know what it is. In the essence, so individual stakeholders, they have a certain fraction of the total number of coins in circulation. So by locking up their coins, they get to pseudo-randomly get picked as the block producer, which is equivalent to miner in this case. And as in exchange for locking up their coins, which is lose of time and lose of liquidity, they get compensated with the Coinbase reward. So the fundamental problem with that is the pseudo-randomness, which is the core of what makes proof of work works. In proof of stake's case, it comes from within the protocol itself. So it's a scaffolding of self-referentiality. So the question is whether any kind of proof of stake can replace proof of work. So the purpose of this presentation is not to do a full dress down of proof of stake. There are already plenty of literature and studies that talks about the all the problems of proof of stake. So in short, it's not possible. And that leads to a more philosophical question is whether the security that achieved by proof of work, whether the security of this decentralized system can only be gained by consuming physical resources. So in a sense, that proof of work is like an alchemy, a bridge between the physical world and the digital world. So with proof of stake, there are plenty of ways that you can attack the network that's very difficult to achieve in a traditional proof of work system, like nothing at stake, selfish mining, long range attack, short range attack. These are all the things you can read about in plenty of literatures out there. And today we're just going to accept that no viable or working pure form of proof of stake is available, right? So going back to proof of work, ASICs are very much an inevitable trend in proof of work networks because these ASICs, which are short for application-specific integrated circuits, if you think about it, it's really amazing because these chips are basically sands that we tricked into thinking, right? And these ASICs, especially for cryptocurrency miners, these are actually very simple things. They are not hard to build. These are not NVIDIA AMD products. And the reason that the Chinese are dominating in this space is because for the past few decades, the entire supply chain is packed in basically one region in South China. So they already have the entire supply chain in that one place, and designing this kind of chip is not, you don't need the top scientists at Intel to do this. So that's why this industry got iterated very quickly in Shenzhen, China. And many new teams have started exploring ways to resist ASICs, right? You have Sia team, which they decide to manufacture their own ASIC for some reason. And you have Monero that decided to periodically hard fork to change their proof of work algorithm so that there's no single ASIC that can stay on the network for more than 6 months. And you have delegated block producers like EOS. Okay. And which makes it no longer a decentralized cryptocurrency network, or you like projects like Grin or some of the earlier EcoHash based cryptocurrencies that implement memory hard algos to make ASICs much more expensive to manufacture. So the question is, so now we're stuck with proof of work and in a foreseeable future, and we know that ASICs are an inevitable trend. So are we just going to spend the rest of the face of cryptocurrency just oscillating between the tyranny of structurelessness and the delicate balance of terror? So the question is, how are we going to design an architecture that have all the benefits that can actually benefit from ASICs without triggering these two extremes? And the answer is viewing proof of stake and proof of work as two different abstraction layers. And in essence, they are doing very different things. And it's very common for people to confuse that think proof of stake necessarily has to be on the consensus layer. So what do we know so far? And obviously, this matrix is a highly simplified view of how these things work. So we know with proof of work, it's very secure, and it's cumulative, meaning that more proof of work can actually make the network more efficient about proof of history, which is the chain history. But it's not very efficient about consensus on rules because it leads to a delicate balance of terror or a tyranny of structurelessness. And what do we know about proof of stake? We know it's not very good for consensus about history. We know it's not secure, but it's still a very efficient way to get feedbacks on what people think, because voting is still a much more liquid and efficient way to collect feedbacks, right? So it's in comparison, it's a democratic distribution of authority. So once we have realized that proof of stake and proof of work are essentially doing two different things on two different abstraction layers, we can put them together. We can put proof of stake on top of proof of work. So this leads to the Decred architecture. What's interesting about Decred is that the Coinbase reward doesn't 100% go to the miners. 60% goes to, actually in reality 58%, as Dave Collin corrected me recently. The 60% goes to proof of work miners, 30% goes to proof of stake stakers. So these stakers are essentially full node operators. In Bitcoin, you run them at your own cost, right? It's the whole trust verify thing. But in this case, full node validators actually get paid. And 10% of the Coinbase reward goes to this treasury system, which is also very interesting, but it's beyond the scope of this presentation. So in this architecture, in this hybrid architecture, we can actually achieve the fork resistance that we mentioned above. It makes it much harder for a mining cartel just to simply go fork the history of the chain. And also it manages the balance of power, because by distributing a portion of the Coinbase reward to full node operators, you actually create this very nice balance of power between the full node operators and the miners. So, so the idea is that, with fully compensated full node operators, they are trusted to act honestly in order to collect the staking rewards. And miners, they also have to act honestly now, because the full node operators can essentially vote their block out. So, and reject their block from getting added to the blockchain. So such hybrid proof of work, proof of stake architecture, this shift will theoretically prevent the network from descending to this perpetual fluctuation between the delicate balance of Terral, which is miner control, and the tyranny of structuralness, which is developer control. So now we have a very nice architecture that can naturally benefit from the introduction of ASICs. So the more ASICs in this network means that it can benefit, it can grow the proof of work base, makes it more efficient, but at the same time, you don't have the common problems that mining cartels or core developer concentration brings. So, and in fact, Decred is in the early stage of what I would call ASICization. So even though in the past few months, the hash rate of Decred has grown very significantly, but this is still at the infant stage compared to other networks such as Bitcoin. And very recently, a lot of manufacturers have started putting out mining hardwares. MicroBT is, the WhatsMiner is the most efficient product out there on the market. And this is actually designed by the same engineer who designed Bitmain's S7 and S9. And they have a little bit problem with on the equity arrangement, so he left to start his own company. And the second best is StrongU. This is a little bit embarrassing because this company, this product is started by this fund called Calling Star, and they are they're the original backers of this project called Hcash, which is a terrible fork of Decred's code. And obviously, you have Bitmain and miner DR3, and the list goes on. The point is, Decred has started to attract many different manufacturers to look into specifically building Blake machines, and this competition is going to become very interesting. And so what does all of this mean for smart investors who want exposure in mining? So like we have talked earlier, all these things, all these 4 steps needs to be heavily optimized in order for you to run a successful operation. You need the connection to the best ASIC manufacturers. All these new machines are coming out every day, and you want to make sure that you have the right information. You want to make sure you are getting them at the right price and right time. And you need to make sure that you are running your machines at absolute lowest possible price, at the lowest possible places. So even like 0.1 cent, that makes a huge difference. And you want to make sure your mining facility is fully optimized, and you want to make sure you have certain control or certain access to the pool operators that host your machines. So the first and most important problem is if you are starting a mining operation, how do you choose the right network to mine? And for all the reasons that was stated just now, Decred seems to be a very interesting and a very valuable alternative to mining Bitcoin. Because if you're starting a mining operation, you are fundamentally taking a very risky long position, and it's very capital heavy. So you want to make sure that project is going to exist for at least the next 20 months. And also it will not descend into total chaos because you are contributing massive amount of hash rate to destroy the health of the network. And in addition, Decred has this nice proof of stake feature which lets you collect interest when you don't want to sell your Coinbase reward, and you can collect interest by staking and further making contribution to the network. So the next question is where to set up your operation, and we know most of the mining facilities are in China, and this is because they're close to the manufacturers, and also there are a lot of very standardized data centers that have been optimized for years. Actually, the first high-density Bitcoin mining facility was started in 2012 by a hydro plant in Sichuan, and so and electricity is very cheap. But even at this point, the average rate for mining in China has already become starting to get saturated, and large mining operators in China are moving to Russia or North Africa, places like that. And the big problem with mining in the US, despite there are plenty of very cheap electricity, very nice data center operations, and very smart people doing that, is the tariff. So now if you ship machines from China to the US, you have to pay 27.5% of tariff on top. So thinking if you want to run operation at scale, thinking about where to host your machine or where to run these machines is critical. And going back to design the right data center, there are a lot of things to consider. You want to make sure that your power is stable. You want to make sure the network connectivity is high. If you're running these in like the middle of like a storm area, your machines probably won't get a lot of work. And the electric design of the place, mechanical design of the place, cooling, staffing, monitoring, security, these are all important considerations to think about. And this brings back to, I guess I haven't really properly introduced myself and also what the project that we do. So iterative capital, we are working on this project NEUTRON, which is a fully stacked mining operation. So we spent the past year basically just traveling in China and making connections to the right local partners and the right manufacturers. So we make sure that we have connections to the absolutely best manufacturer, and we were consciously learning about the right information, and we become the first people to have access to the batch of machines when they come out. And we make sure that we have the right connection with hydro plants in Sichuan that runs these operations at the lowest possible price. And on top of that, we're building our own mining pool, we're building our own staking pool, and we have over-the-counter trading desks that help manage our liquidity. At this point, I think we are one of the largest liquidity provider of Decred. So this concludes my presentation. Yes.
Hello. Yeah, I actually have a question. So I don't understand that a year ago, mining was somehow profitable when Bitcoin was $1,000, and now it isn't when it's at 6,000. What has changed? What has caused this odd deficit?
Yeah, the biggest driver is obviously difficulty, right? And if you, I don't have a chart already available right now, but if you compare the difficulty of Bitcoin from a year ago, the last year has just been crazy. And also last year, Bitmain was probably the dominating manufacturers for manufacturing machines, but now this year, in addition to Bitmain, you have all these, you have Canaan. Well, Canaan has been around for a while, but they start to put out new products. A lot of new manufacturers have come to the market and start making better machines, even better than Bitmain. So new, better machines that come at a cheaper cost are flooding the market. That's the biggest change compared to a year ago.
What's your thoughts on mining in already saturated algorithms like, Bitcoin or whatever, Equihash? And also, do you think that mining will be profitable in the future if you're going to stay in a place like Texas, 5-cent kilowatt, whatever? How do you think the future is going to look for us that aren't willing to go to China, et cetera?
Yeah. So yeah, I mean, going outside the U.S. is obviously have a lot of trade-off. You need very strong local partners in order to pull that off, and you have to trust that local partner not to screw with you, right? So going back to your point on saturated algorithms, obviously choosing the right choosing whatever network that you commit to is a huge commitment because you're taking a long position with a lot of capital. So just according to my observation, a lot of people are still sticking, large-scale operators are still sticking with BTC because that's the easiest thing to explain. So I think mining BTC is still profitable if you can manage all the 4 steps that we have mentioned earlier, if you can absolutely optimize every single layer in the stack, and also you just need scale. You need a lot of S9s to make it work. Same with EcoHash.
Sorry, one more question. Do you see, I guess, everybody talks about the possibility of other miners existing that aren't available to us here in the U.S. Do you see that as an actual threat and a real problem, or is that just kind of hearsay?
I think it's definitely a problem because one, these machines are manufactured elsewhere, and it's very difficult for us to become the first people to get access to these machines, right? And secondly, by the time these things ship to U.S., there's another 27.5% of tariff on top, so which makes it a huge disadvantage. So I think in the near future, if someone can make a U.S. native mining machine that's not terrible, I think that there's a huge opportunity there for the manufacturer. And again, these chips are not difficult to design. These are not AI chips. These are not general computing chips.
Do you think that the Bitmain facility going into Rockdale could possibly be a point of distribution?
I don't know. I think that's more of a marketing gesture to make their IPO look good than actually they're going to put a lot of machines there. In their IPO document, one thing I thought is very, very interesting that is Bitmain recognized that their brand is very weak in overseas. I think they realize that the business ethics or business conducts they have been doing doesn't make them popular among people that are not associated with Bitmain. So I think that facility is more for marketing purposes. And also, even if that facility is not in the U.S. or anywhere else, the beneficiary are still the people who invested them. Their shareholders, not us.
Could you explain for a pure proof-of-stake system, there's been, I don't know the underlying mathematics or anything, but there's a problem with the pseudo-randomness and stuff like that. Why don't you have that problem with a hybrid proof-of-work, proof-of-stake?
Yes. So with hybrid proof-of-work, proof-of-stake, actually the actual consensus is still established. The consensus of the version of which chain is the right version. That's still very much determined by the proof-of-work. And proof-of-stake is just that layer actually works for full node operators. So what happens is the miners still do what miners do. They produce the block, and they show this block to the full node operators, and the full node operators vote to determine if this block is valid or not. So the process that the miners go through to make the block production secure is still the same process in hybrid proof or proof of stake. It's just the difference is that the full node operators now get paid through proof of stake.
So, but you still have randomness in which stakeholders get to vote in the hybrid system, right? But I guess it's not like a fundamental problem.
It's not a fundamental problem. With the pure proof of stake, the pseudo randomness come from like the cryptographic primitive within the protocol. So that one, I personally think is a complexity theater that some academics that they been ignore for decades have realized that this is the hot thing now that they can use to raise money. So I think, sorry, just to finish that, the fundamental question is whether these decentralized systems can work without drawing physical resources. Can this thing become like a working self-referential thing that exists purely in the digital sphere? I think that's the philosophical question there. but it's more of an engineering question too.
I did hear a presentation at BitDevs in New York talking about one manufacturer that was going to somehow do proof of work without all the energy expenditure. They were using like photonics or something like that.
I was there too, actually.
Yeah, I have no idea what's going on.
I'll explain why it doesn't work later, offline.
So if the ASIC chips are so easy to manufacture, in fact, or they're not very complex, why are they not being manufactured in US, in fact? Is there any reason other than the manufacturing base has shifted there, or is there any other reason why they are not being manufactured here?
I think the biggest problem is actually the supply chain, because the supply chain is just the advantage of doing this in China is that the entire supply chain is just within few districts, and you can just literally drive next block to find your supplier or your downstream business, right? So, but with U.S., I don't think it's the lack of chip design talents. But if after chip design, you still have all these processes to manage before you can pack the full product. So and especially compared to the labor costs, just the years of manufacturing expertise on this type of simple hardware that Shenzhen, China has accumulated, that makes it harder. But I think at this point it's not. Because it's not like a secret, right? It's not how do you make, what's the ingredients that go into Pepsi? Actually, I don't think that's a secret either at this point. So I think it's doable. Just waiting for someone to do it.
I don't need the mic. I'll plug in more. Sorry. So like the What's miner is 44 terahash, right, on Decred. We have 30 Ivy Link DSM-60s, okay? So 6 months ago, that was the big boy miner. Here we are 6 months later, and there's something 8 times faster. I mean, we can replace all 30 of those, 180K worth of miners for X, right? Do you think we're going to come up on thresholds in the near future, physical thresholds that are, when you look at terahash per watt and things like that, that ultimately we're going to say, okay, kind of like a car. Crossing that 200 mile an hour threshold is a big deal, but 250, they're just not going to do it anytime soon. Are we bumping on the rail or is what I'm saying?
Yeah, so I think even if we see that threshold, we're going to see it in the Bitcoin machines first.
Okay.
So because right now, even the most advanced machines are still using 16 nanometer chips, right? But with BTC, after we venture into 7 nanometer or even 5 nanometer realms, we're going to see full customization methods play a much more important role than just simply hopping onto the more advanced tech nodes. So whether we're going to reach a thermodynamic absolute limit, I think that will happen in BTC first, just because sheer market momentum there is greater. And just to follow up your point on these big boys machines, I think another big problem with all these 44 terahash is that they draw too much power, like 2200 watts. That's a lot. That burns their PSU very easily. So my point is there are still a lot of things that we need to optimize on before we see that absolute limit.
So if you were to buy another X number of dollars worth of a lot of miners in the next 6 months, what algo would you be mining?
I'll tell you offline.
All right.
I'd like for everybody to give Leo a round of applause.